When will mortgage rates drop? It's the most searched question in housing right now, and honestly, most of the answers you'll find are either guru speculation or wishful thinking. Here's what the actual data says, what's keeping rates elevated when they're likely to come down, and what to do in the meantime. First, the context most videos skip. The 30-year fixed rate today sits at 6.44%. That feels high if you remember 2021, when rates were under 3%. But back in 1981, about 4 decades ago, mortgage rates peaked at 18.4%. By historical standards, today's rate is right in the middle of normal. The question isn't whether rates are too high. It's whether they're going to drop, and when. Here's the part most beginner videos get completely wrong. The Federal Reserve does not set mortgage rates directly. The Fed sets the federal funds rate. That's the rate banks charge each other for overnight loans. Mortgage rates are a totally different animal. They follow the 10-year US Treasury yield, which is set by the bond market. Your mortgage rate is roughly the 10-year Treasury yield plus 1.5 to 2%. That extra is called the mortgage spread, and it covers the lender's risk and profit. So when people ask, when is the Fed going to lower mortgage rates? The honest answer is, the Fed can't directly. It can only influence the bond market, which then moves the 10-year yield, which then moves mortgages. And here's an extra wrinkle. Right now, the mortgage spread, the gap between the 10-year Treasury yield and your mortgage rate, is about 2.7%. The historical norm is 1.5 to 2%. So even if the 10-year Treasury drops, mortgage rates have an extra cushion to come down before the spread normalizes. This wide spread is one of the reasons rates have stayed stuck. Here's the broader picture. This is the 30-year fixed mortgage rate since 1971. It started around 7.5%. By 1981, driven by the inflation crisis at the time, it peaked at 18.4%. From there, rates trended down for 40 years. They bottomed at 2.65% in 2021. That was the lowest rate in US history, driven by the Federal Reserve's pandemic-era policies. Then inflation came roaring back, the Fed raised rates, and mortgages spiked. Today's rate of 6.44% is high compared to 2021, but it's actually right in the middle of the long-term historical range. So what's keeping rates stuck at 6.4%? 4 reasons. 1. Inflation is still elevated. The most recent reading came in at 3.3%, well above the Fed's 2% target. We covered this in our recent inflation video. 2. The Fed has paused. They cut rates 3 times in 2025, but have not cut yet in 2026. The market expects them to stay paused until at least the second half of the year. 3. The Iran war is keeping energy prices elevated, which feeds into inflation expectations, which keeps the 10-year Treasury yield up. 4. The mortgage spread is unusually wide, adding extra cost on top of Treasury yields. All 4 would have to ease for rates to drop dramatically. So when do they actually drop? Here's what the major forecasts say. Fannie Mae and the Mortgage Bankers Association both expect rates to land between 5.7 and 6.3% by the end of 2026. Morgan Stanley sees rates around 5.75%. The National Association of Home Builders predicts 5.99% average for the year. Notice what nobody is predicting: 3% rates returning. That era was a once-in-a-lifetime anomaly driven by emergency Fed policy during the pandemic. It is almost certainly not coming back. Realistic expectations: rates drift slowly down, settling in the 5.5 to 6% range over the next year or two. So what should you actually do about it? 4 moves. 1. Stop waiting for 3% rates to come back. They were an anomaly, not a baseline. Most of human history, mortgage rates were higher than today. 2. Run the math on your specific situation. The break-even on a refinance depends on closing costs, how long you'll stay in the home, and the rate gap. There are free calculators that do this in 30 seconds. 3. If rates do drop, the rule of thumb is to refinance when your new rate is at least 1 full percentage point below your current. That's usually enough to cover closing costs within 2 to 3 years. 4. If you're buying right now, lock in your rate. The risk that rates rise further before you close is bigger than the small chance they drop 0.1% in 2 weeks. 3 myths to bust before you go. Myth 1. When the Fed cuts rates, mortgage rates drop. Half true at best. The Fed sets short-term rates. Mortgages follow the 10-year Treasury, which moves on inflation expectations and bond market dynamics. Sometimes Fed cuts move the 10-year, sometimes they don't. Myth 2. Mortgage rates will return to 3%. Almost certainly false. 2.65% in 2021 was a once-in-a-century anomaly during a pandemic. The historical normal is 6 to 8%. Myth 3. I should always wait for lower rates before buying. False. The right time to buy a house is when you can afford it. Plan to stay at least 5 years, and the math works for your specific situation. Trying to time mortgage rates almost never wins. Mortgage rates aren't dropping fast. The Fed isn't really in charge of them. The forecast is gradual decline to maybe 5.5 to 6% by year end, not 3%. If you're waiting for a return to 2021, you'll be waiting forever. Make decisions based on the math, not the hope.